Tonight you're going to open an app and check a number you already know you're going to hate: your student loan balance. You've been paying for years, real money, real sacrifice, and somehow the number barely moved. You'll blame yourself. Bad luck, a bad degree, a bad decade to graduate. But the real reason has very little to do with you, and it's been sitting in plain sight since the 1960s. It's not your spending, it's not your job, it's the math itself, and the system built around that math. Here's what almost nobody explains clearly: a student loan is not really a debt in the way a credit card is a debt. It's closer to a subscription that compounds against you every single day you don't pay it off completely. Let's start with the number you actually see. Say you borrowed $40,000 for college. That number feels finite, countable, beatable. But underneath that number is an interest rate, and that interest rate doesn't wait for you to graduate, find a job, or get your first paycheck. It starts working immediately, often before you've even attended your first class. This is called capitalization, and it is the single most misunderstood word in the entire student loan system. Here's how it works. Interest accrues daily on your unpaid balance. If you don't pay that interest as it accrues, in many loans it gets added to your principal at certain trigger points, like leaving a deferment or missing a payment plan deadline. Once it's added to principal, you now owe interest on the interest. Your loan balance can grow even while you are actively making payments, if those payments are small enough that they don't outrun the daily accrual. Economists have a simpler way to describe this. It's the same force behind compound interest anywhere else in your financial life, except here, most borrowers don't realize it's running against them instead of for them. Richard Taylor, the Nobel Prize-winning behavioral economist, spent decades studying why humans are terrible at reasoning about compounding. His research on what he called mental accounting showed that people treat money differently depending on which mental bucket it sits in, rather than treating all dollars as fungible. A student loan payment gets mentally filed under handled. You paid it. You did your part. Your brain checks the box and moves on. But the loan servicer's math doesn't check any box. It just keeps compounding. This is where the second piece of the system enters, and it has a name that sounds almost too simple to be dangerous: the minimum payment. Minimum payments are calculated to be affordable. That's the entire selling point. Lower monthly payments mean more people can technically service their debt without defaulting. Income-driven repayment plans, introduced by the federal government starting in the 1990s and expanded significantly in later years, cap your monthly payment as a percentage of your income rather than as a percentage of what you actually owe. Sounds compassionate. And in a real sense, it is. It keeps people out of default and off their parents' couches. But here's the twist nobody puts in the pamphlet. If your income-based payment is smaller than the interest accruing that month, you are not paying down your loan at all. You are paying less than the interest. The difference gets added right back onto your balance. You can make every single payment on time for years and watch your balance go up. This isn't a glitch. It's how the formula is designed to behave under those specific income and interest conditions. Researchers studying student debt, including economists at the Federal Reserve Bank of New York, have documented this pattern extensively using national loan data. Their studies show a large share of borrowers on income-driven plans see their balances grow, sometimes for a decade or more, before the math finally tips toward paying down principal. Why? Because the entire system was originally built around a different kind of borrower. Let's go back further to where all of this actually started. The modern federal student loan system traces back to the National Defense Education Act of 1958, passed in the shadow of the Soviet Union's launch of Sputnik. Lawmakers wanted more American engineers and scientists fast, and low-interest federal loans were the tool to get them there. For decades, this system worked reasonably well, because tuition was a fraction of what it is today, and loan balances were small enough that even minimum payments outpaced interest. Then tuition changed. Between the 1980s and today, the cost of a 4-year degree at many institutions grew several times faster than inflation, according to data tracked by the National Center for Education Statistics. Wages for new graduates did not grow at anywhere close to that pace. Loan balances got bigger, loan terms got longer, and suddenly, the same repayment formulas that worked fine on a $5,000 loan started behaving very differently on a $50,000 loan. This is the counterintuitive twist economists keep returning to. A repayment system can be perfectly reasonable at one loan size and mathematically brutal at another, without a single rule ever changing. There's a second force working alongside interest, and it's psychological rather than financial. The behavioral economist George Loewenstein, known for his research on how people undervalue future costs compared to present ones, has written extensively about why long-horizon debt feels less urgent than it is. A bill due in 20 years doesn't trigger the same anxiety response as a bill due next week, even if the 20-year bill is objectively larger and growing. That's why so many borrowers select the lowest available monthly payment without fully modeling what that payment does to their balance over time. It's not carelessness. It's how human brains are built to weigh time. Loan servicers. The private companies contracted to manage federal loan accounts generally aren't required to walk borrowers through this math in plain language at the moment they choose a plan. Several servicers, including one of the largest, Navient, faced lawsuits in a multi-state settlement over allegations that they steered borrowers toward forbearance, a pause on payments that lets interest keep accruing and capitalizing, instead of into income-driven plans that might have actually reduced long-term costs. Navient settled without admitting wrongdoing. But the case put a spotlight on how servicer incentives don't always line up with what's best for the borrower. So you end up with a loop, a payment that feels responsible, an interest rate that never stops, a balance that quietly grows in the background, and a decade or two later, you check the app, and the number that was supposed to shrink looks almost exactly like the number you started with, sometimes larger. This is the part almost nobody feels in the moment they sign the paperwork. At 18, you're not thinking about capitalization schedules. You're thinking about which dorm to pick. The system was built by people who understood exponential math extremely well, for people who, at the moment they agreed to it, understood almost none of it. Now think about what this does over an entire lifetime, not just a single decade. A 22-year-old graduate enters an income-driven plan expecting to be debt-free in 20 or 25 years, the timeline advertised on the loan servicer's website. That timeline includes a provision most borrowers skim past. Any remaining balance at the end of the term is forgiven, but that forgiven amount can be treated as taxable income in the year it's canceled. Economists studying the program have pointed out something almost nobody plans for. If your balance grew for 15 years before finally shrinking, the forgiveness event at the end can trigger a tax bill in the tens of thousands of dollars, arriving the same year your loan disappears. You spend 2 decades relieved that the loan is finally gone, and then the IRS sends a letter asking why you didn't report the forgiven balance as income. This is the modern mirror of the entire system. It isn't one bad moment. It's a chain of individually reasonable decisions, each one making sense on its own, that adds up to an outcome nobody would choose if they saw the whole picture at once. Compare this to a mortgage, which most people intuitively understand better despite being a larger loan. A mortgage has a fixed amortization schedule you can look up in seconds. Payment 1 goes mostly to interest, payment 360 goes mostly to principal, and the whole schedule is public, standardized, and printed on an amortization table anyone can request. Student loans, especially income-driven ones, have no such fixed schedule, because the payment is tied to income that changes every year. Your amortization table isn't printed anywhere. It's recalculated annually based on a tax return, and almost nobody, including many loan counselors, can tell you in advance whether this year's payment will shrink your balance or grow it. That uncertainty isn't a side effect. It's a structural feature of a variable formula applied to a fixed, compounding balance. There's a reason this doesn't get fixed through outrage alone. Elizabeth Warren, before entering the Senate, spent years as a bankruptcy law professor studying how consumer debt products are structured, and one of her recurring arguments was that complexity itself functions as a kind of pricing tool. A product that's difficult to fully understand is harder to shop around for, harder to compare, and harder to organize political pressure against. Nobody protests a formula they can't quite explain to their neighbor. Contrast that with credit card debt, which gets far more media attention despite, in aggregate, being smaller than the total outstanding student loan balance in the country, which has sat above $1.6 trillion in recent years according to Federal Reserve data. Credit card debt is visible in a monthly statement with a clear minimum payment and a clear warning about how long payoff will take at that minimum. Student loan servicing statements, until relatively recent regulatory changes often buried this information or presented it in a way that made the true trajectory of the balance difficult to see at a glance. So what actually breaks the loop, if you're living inside it right now? The first thing to understand is that not all extra payments are equal. A payment applied directly to accrued, unpaid interest first before it capitalizes does more to shrink your long-term cost than the same dollar amount applied later, after that interest has folded into principal and started generating its own interest. Timing a small additional payment before a capitalization event, such as the end of a grace period or the end of a deferment, can prevent that interest from ever becoming principal at all. The second thing is recalculating every year whether your income-driven payment is actually outpacing your interest accrual. Loan servicers are required to send an annual statement showing your current balance, but they aren't always required to highlight, in plain language, whether this year's payments reduced your principal or simply covered part of your interest. You have to do that comparison yourself, balance versus last year's balance, to know which direction you're actually moving. The third is understanding that refinancing into a private loan, while it can lower your interest rate, also permanently removes you from federal protections like income-driven repayment and potential forgiveness. It's a trade, not a universal upgrade, and the right choice depends entirely on your specific income trajectory and loan type. None of this requires financial genius. It requires knowing which number to look at, which almost no one tells you. So tonight, when you open that app and see the balance, you'll know something most people never learn. It isn't a scoreboard of your effort. It's a formula, running quietly in the background, built decades ago. For a different kind of loan, on a different kind of income, at a different moment in history. The number was never really about you. It was about the math. And once you see the math, you can finally start beating it.